Good morning, everyone. I'm excited to discuss what was truly a landmark week for markets. The Federal Reserve finally delivered the rate cut investors had been anticipating, and markets responded with enthusiasm, though not without some important nuances we'll explore today. We saw record highs across major indices, but beneath the surface this week told a story of selective strength and emerging opportunities. Let's dive into what happened and what it means for our investment approach. The headline story was straightforward. The Fed cut rates by 25 basis points for the first time in 2025, reducing the federal funds rate from a range of 4.25 to 450% to 4.0 to 4.25%. Markets had been pricing this in, but confirmation provided the catalyst investors needed. What's particularly noteworthy is how this played out. Technology companies led the charge to fresh record highs, exactly what economic theory would predict. When borrowing costs fall, it increases the present value of future cash flows, and growth companies with longer duration earnings profiles benefit most. This wasn't just a broad rally, it was a particular economically logical response. Let me break down the three key takeaways from this rate cut. First, the mechanics. Borrowing became cheaper for both companies and consumers. This 25 basis point reduction may seem modest, but it signals a meaningful shift in Fed policy. Second, market reaction was swift and decisive. We saw new record highs across major indices, with technology stocks leading the way. Third, and this is crucial, we witnessed significant sector rotation. Growth stocks outperformed dramatically, while traditional dividend-paying sectors, such as utilities and real estate, actually declined. This tells us investors are repositioning for a lower rate environment. The numbers speak for themselves. Looking at our chart, you can see the week's performance alongside year-to-date returns. The NASDAQ 100 was our standout performer, up over 2% for the week and approaching 18% year-to-date. The S&P 500 gained nearly 1%, bringing its year-to-date return to over 13%. Even small caps, represented by the Russell 2000, participated with modest gains. What's striking is the consistency of these gains. This wasn't a flash-in-the-pan rally. It was broad-based participation across market capitalizations, though clearly favoring growth over value. All major indices finished at or near record highs. That's significant. But the real story is in the why. The technology-heavy NASDAQ performed best because tech companies benefit most from lower interest rates. When companies can invest more cheaply in growth initiatives, research and development, infrastructure, expansion, their long-term earnings potential increases. This validates our focus on companies with strong competitive moats and growth prospects. Quality businesses with pricing power and cash generation capabilities are exactly what should outperform in this environment. The sector performance tells a compelling story about where capital is flowing. Technology led with nearly 3% gains. Software, semiconductors, and AI companies were particular beneficiaries. Communication services followed at 1.76%. Social media and streaming companies benefited from the same growth dynamic. Consumer discretionary rounded out the top three at 1.16%. Notice the theme here. These are all sectors where future growth potential matters more than current dividend yields. The flip side reveals just as much about market psychology. Real estate fell over 1%, and here's why. When Treasury yields rise, which they did this week despite the rate cut, and property companies become less attractive relative to bonds, investors can get better yields elsewhere. Consumer staples and utilities also declined. These are traditionally defensive sectors that investors buy for steady dividends. In a growth-oriented environment, they're simply less compelling. This rotation tells us investors are positioning for expansion, not defense. This slide captures a fundamental principle of finance that played out perfectly this week. When the Fed lowers rates, it reduces the discount rate we apply to future profits. Growth companies benefit more than dividend-paying companies because their value depends heavily on profits that will come years from now. Think of it this way. If you can't earn as much by putting money in the bank, stocks that promise future growth become relatively more attractive. Meanwhile, stocks you buy primarily for their dividends lose some appeal because bonds and savings accounts provide less competition. This is exactly what we saw this week, a textbook rotation from yield to growth. Let's examine the Fed's rationale more closely. This was the first rate cut since December 2024, and importantly, it was widely expected. The Fed cited concerns about the job market cooling down. Recent employment reports showed hiring has slowed and unemployment has ticked up. This wasn't a panic move. It was a measured response to evolving economic conditions. The Fed is trying to support the labor market while inflation remains relatively contained. Chairman Powell's communication was critical this week. He emphasized this was risk management, not the start of an aggressive rate-cutting cycle. The Fed is being cautious. They're adjusting policy gradually based on incoming data. This measured approach is actually positive for markets. It suggests the Fed sees the economy as fundamentally healthy, but wants to provide some insurance against potential weakening. That's a Goldilocks scenario for risk assets. Markets initially rose on the news, but then we saw some choppiness as investors digested the implications. The volatility reflected an important question. Is the Fed cutting rates because they see economic weakness ahead, or are they just being proactive? This debate will continue to influence market dynamics. Short-term volatility around Fed decisions is normal. What matters more is the underlying health of the companies we own. Let's look at some standout individual performers and understand what drove their success. Intel surged 23%. The biggest story of the week, Chewy. NVIDIA announced a $5 billion investment partnership with Intel for AI chip development. This validates Intel's strategy to compete in artificial intelligence, where it has lagged competitors. Novo Nordisk jumped 7.6% on promising results for their once-daily obesity pill. The data showed weight loss results matching their popular Wegovy injection, potentially opening a much larger market. Tesla continued its rally, up 6%, on optimism about autonomous driving and energy storage developments. The Intel story deserves special attention because it represents a potential inflection point for the semiconductor industry. NVIDIA's $5 billion investment isn't just capital, it's validation. This partnership gives Intel access to crucial AI technologies it needs to compete effectively. For investors, this demonstrates how quickly competitive dynamics can shift in technology. Companies with strong balance sheets and innovation capabilities can stage remarkable comebacks. Novo Nordisk's development represents exactly the kind of innovation we like to see in our healthcare holdings. Moving from injection to oral medication dramatically expands the addressable market. Many patients who avoid injections would consider a daily pill. This illustrates why we focus on companies with robust R&D pipelines and strong competitive moats. Pharmaceutical companies with breakthrough treatments can create substantial shareholder value. Not every stock participated in the rally, and it's important to understand why. FactSet Research fell 20% without clear negative news. This appears to be institutional portfolio rebalancing rather than fundamental deterioration. Dexcom dropped 11.5% after a negative short seller report. However, the fundamentals of the diabetes monitoring market remain strong. Sometimes market reactions create opportunities for patient investors. These declines remind us that even in strong markets, individual stocks can face headwinds. This is why diversification and focus on business fundamentals matter. Our portfolio had a strong week, and I'm pleased with how our holdings performed. Several of our positions posted significant gains, driven by companies with exactly the characteristics we target: wide competitive moats and strong cash flow generation. This week validated our investment approach. Quality businesses with sustainable competitive advantages tend to outperform during market rotations like we experienced. Let me highlight our best performers. ASML jumped 14.5% our semiconductor equipment leader, benefited from the renewed AI infrastructure demand sparked by the Intel-NVIDIA partnership. Novo Nordisk up 11.9%, delivered on the strong obesity drug trial results we just discussed. Tesla continued its momentum at 7.6%, while Alphabet gained 5.8% on continued strength in search and cloud business. Notice these are all companies with strong competitive positions and growth prospects, exactly what we want to own in a lower rate environment. A couple of our holdings faced headwinds, but I view these as temporary rather than fundamental. S&P Global declined 6.8%, likely profit-taking. After strong year-to-date performance, the business fundamentals remain excellent. Copart fell 5.3% on director stock sales, which pressured sentiment temporarily. These declines were primarily technical rather than fundamental business problems. In fact, they may represent opportunities to add to high-quality positions at better prices. This week perfectly illustrated why we stick to our investment philosophy. First, competitive moats. Advantages that protect companies from competitors. Second, pricing power, the ability to raise prices without losing customers. Third, strong cash flow, consistent cash generation for reinvestment and returns to shareholders. Our best performers this week: ASML, Novo Nordisk, Tesla, Alphabet, all exhibit these characteristics. This isn't a coincidence, it's the power of systematic, quality-focused investing. The economic backdrop supporting the Fed's decision continues to look constructive. Initial jobless claims fell to 231,000, below expectations of 240,000. This suggests the job market, while cooling, isn't collapsing. This is exactly what we want to see, a gradual cooling that gives the Fed room to ease policy without signaling economic distress. It supports the soft landing scenario where growth slows but remains positive. The producer price index at 2.6% year over year gives the Fed room to continue its measured easing approach. Wholesale inflation remaining contained means businesses aren't facing significant cost pressures that would force them to raise prices aggressively. This supports both corporate margins and the Fed's ability to focus on employment rather than fighting inflation. Retail sales data showed consumers continued to spend, though growth has moderated. This supports the soft landing scenario, where the economy slows but doesn't fall into recession. Consumers are being more selective but haven't stopped spending entirely. This environment favors the high-quality companies we own, businesses that can maintain pricing power and market share even when consumer spending growth moderates. Looking ahead, we have several important data points that will influence market direction. Friday brings the PCE report, the Fed's preferred inflation measure. We'll also get housing data showing how rate cuts are affecting home sales, plus earnings from AutoZone and Costco that will provide insights into consumer health. These reports will help us gauge whether underlying economic trends justify the current market optimism. If the Fed continues cutting rates, history shows us which sectors typically benefit most. Growth stocks outperform value stocks because lower rates increase the present value of future earnings. Small cap companies benefit more than large cap companies because they rely more heavily on borrowing for growth. Interest-sensitive sectors like technology and real estate investment trusts typically perform well. Our portfolio is well positioned for this environment, with our emphasis on growth companies with strong fundamentals. The central question facing markets is whether the Fed is cutting rates because they see economic weakness ahead or because they're just being proactive. The answer will determine whether this rally continues. If it's proactive risk management, we could see sustained strength. If it's a response to hidden weakness, we may face choppiness ahead. This is why we focus on owning great businesses rather than trying to time policy cycles. Quality companies can thrive in either scenario. Our portfolio's strong performers all share dominant market positions, pricing power, and strong cash generation. They succeeded not because we timed the market perfectly, but because we own companies that benefit from favorable economic conditions. This is the power of quality investing, positioning ourselves to benefit from economic tailwinds while protecting against downturns through business quality. The Fed's rate cut is positive for stocks, but it doesn't change our fundamental approach. We continue focusing on companies that can grow earnings regardless of economic conditions while trading at reasonable valuations. This discipline has served us well and will continue to guide our decisions. Market cycles come and go, but great businesses compound wealth over time. That remains our North Star. The most important lesson from this week: avoid chasing headlines. Don't try to time the Fed's policy moves. Instead, own high-quality companies that compound wealth over time. Rate cuts are just one factor among many for long-term investment success. Our approach of owning businesses with sustainable competitive advantages positions us well regardless of short-term policy changes. Before we wrap up, let me clarify a few key terms we've discussed today. Basis points. Remember, 25 basis points equals 0.25%. The federal funds rate is what banks charge each other for overnight loans, which influences all other interest rates in the economy. Present value is the current worth of future money. When rates fall, future cash flows become worth more today. And competitive moats are business advantages that protect companies from competitors, like strong brands or patents. The soft landing scenario we've discussed represents an economic outcome where growth slows enough to control inflation, but not enough to cause a recession. Current data supports this optimistic outcome. Employment remains healthy, inflation is moderating, and consumer spending continues, though at a slower pace. This would be an ideal environment for the quality growth companies we favor. The soft landing scenario we've discussed represents an economic outcome where growth slows enough to control inflation, but not enough to cause a recession. Current data supports this optimistic outcome. Employment remains healthy, inflation is moderating, and consumer spending continues, though at a slower pace. This would be an ideal environment for the quality growth companies we favor. This week's events reinforce our commitment to quality investing. We focus on businesses with sustainable competitive advantages that can thrive across different economic environments. Technology leaders, pharmaceutical innovators, companies with network effects. These are the businesses that create long-term wealth. The performance this week validates this approach and gives us confidence in our long-term strategy. Quality businesses owned for the long term remain the best path to financial independence. Short-term market movements are less important than owning great companies. The headlines will change, but our focus on business quality and long-term value creation remains constant. This is how we build wealth, not by timing markets, but by owning pieces of exceptional businesses that grow more valuable over time. Thank you for your attention today. I'm excited about our portfolio positioning and the opportunities ahead. If you have questions about your portfolio allocation or want to discuss your long-term financial strategy, our team is here to help. We believe strongly in the power of quality investing approaches, and this week's performance demonstrates why. I look forward to continuing this conversation with you individually and updating you on our progress next week. Before we conclude, I want to remind everyone that this material is for informational purposes only and should not be considered specific investment advice. Past performance does not guarantee future results. All data reflects market performance through Friday, September 20, 2025. Stay focused on quality businesses and long-term wealth creation through disciplined investing. That's our path forward.